Welcome to our Planning for 2018 workshop with the Tax Law Update. First, we will take a look at the Tax Cuts and Jobs Act, and then we'll discuss some general planning strategies you can consider. Before we begin, it is always important to review that there are 5 key areas of financial planning. They are protection, retirement plan, investments, tax planning, and estate planning. As a comprehensive financial planning firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas of our clients. Now let's take a look at the Tax Cuts and Jobs Act. Congress approved the Tax Cuts and Jobs Act on December 22, 2017. President Trump signed into law the most sweeping overhaul of the U.S. tax code in 31 years. Key policy highlights that could impact most investors are: 1. It kept 7 tax brackets but reduced the rates. The standard deductions increased. It created state and local tax limitations, referred to as SALT. The child tax credit doubled. Mortgage interest rate deductions available for new mortgages decreased. The alternative minimum tax increased. Medical expense deductions were modified. It eliminated the Affordable Care Act's individual mandate penalty tax. It lowered corporate tax rates. Pass-through income will be taxed differently. Estate taxes remained, but exemption levels doubled. For 2017, we have 7 tax brackets from 10% to 39.6%. and 0 to 20% brackets on capital gains. Now in 2018, we will have 7 tax brackets from 10% to 37%, and still 0 to 20% brackets on capital gains, but coming in at different points. Here is a quick comparison of the pre-tax bill rates that were scheduled versus the new tax rates after the Tax Cuts and Jobs Act. As you can see, most rates are down, with the big winners rate-wise, the lower brackets, and the $237,951 to $315,000. The only real increase on a slight piece of income between $400,000 and $424,950. Not taking the use of deductions into account, taxes paid on income should go down for most people. Here is a graphical comparison of the 2017 brackets versus 2018's. Here are graphical comparisons of 2017 brackets versus 2018's for someone with income $250,000 or less, which would result in less tax, which was the purpose of this bill. Here are the standard deductions for 2017 and the new and higher standard deductions for 2018. Most exemptions were completely repealed at the end of 2017. They are consolidated into the new standard deduction. However, there is an expanded child tax credit and a new family tax credit designed to offset the loss for families. For state and local taxes, taxpayers are now only able to claim up to $10,000 in itemized deductions, $5,000 if married filing a separate return. Here is a summary of the new child and family tax credits. The tax credit for children has increased from $1,000 to $2,000. There is now a credit of $500 for other family members. The income phase out for using these went from starting at $110,000 to starting at $400,000. And for those who pay no taxes, the actual refundable credit for children maxes out at $1,400, not $1,000. For educational provisions in the new Tax Act with Section 529 plans, distributions of up to $10,000 may now be used for qualified expenses for elementary school and high school. Also in 2018, forgiveness of student loan debt will not be taxable income to the student on account of the student's death or total disability. The mortgage interest rate deduction was reduced from $1 million to $750,000, or $375,000 for married filing separately. For those who pay alternative minimum tax, the exemptions have increased. The tax bill expanded medical expense tax deductions for 2 years by setting the deduction threshold to 7.5% for AGI for all taxpayers. The tax bill removed the individual mandate by eliminating the penalty for not having coverage. This goes into effect January 1, 2019. There are some changes to taxation of business entities. There is a change to corporate tax rates. They went from a scale of 15% to 35% to a 21% flat tax rate. As for pass-through corporations, or ones that individuals pay personal taxes on, there are some new business pass-through rates. They include a deduction equal to 20% of domestic qualified business income from a pass-through entity. This provision has many complications, including a phase-out at $315,000 to $415,000 married filing jointly of taxable income. If you have a pass-through corporation, we encourage you to see a CPA for specific details. Now let's visit the estate planning changes. For estate and generational skipping taxes, this new bill doubles the basic exclusion amount in GST exemption in 2018 to $11,200,000 per couple. Please understand that this higher exemption amount sunsets December 31st, 2025 and returns to the current amount. Also, the bill retains the Section 1014 basis adjustment, which allows for a step-up basis at death. Here is a graph that shows how until 2026 the federal estate tax exemption is much higher now than after that date. For retirement accounts, the only major change was to say that the Roth recharacterization cannot be used to unwind a Roth conversion after 2017. Tax planning strategies to consider for 2018 include maximizing retirement plan contributions, tax loss or gain harvesting, tax-exempt strategies, tax advantage strategies. Our goal is simple: to review tax strategies individually when appropriate with clients. One of our main focuses as a financial advisory practice is to review changes for our clients on an ongoing basis. So what can you expect from us? You can expect constant communication, more frequent discussions, and you can expect that we are constantly reviewing economic, tax, estate, and investment issues for our clients. As you know, our role as your advisor is to maintain a non-emotional objective, avoid knee-jerk reactions, assist you in making decisions that are always in your best interest, and we will be here for you. Thank you, and we appreciate the opportunity to assist you with your financial needs.